right, welcome to Iron Financial. This is the place where we forge stronger portfolios, and we do it by putting company earnings through a brutal stress test. Today, we're wading into the regional banking sector. It's a real minefield out there right now, just littered with traps. Finding a bank with real structural strength, bones you can count on, has never been tougher. So let's get our hands dirty.
And that brings us right to the heart of it, doesn't it? The big question for today. You see a bank in this market screaming from the rooftops about record earnings. So let me ask you, is that a sign of a real fortress built on solid bedrock, or is it just a fancy painted facade they put up to look good for a single quarter? We're going to find out if this thing is built to last or if it's just a lot of distracting noise. And our subject today, our case study, is BOK Financial. The ticker is BOKF. Now, they just dropped a press release with the headline, Record Quarterly Earnings. That's a bold claim, right? It's designed to get your attention, to make you feel safe. But is it just hype, or is there real substance there? See, those surface-level numbers, they can be really misleading. So here at Iron Financial, we're breaking out the heavy tools. We're going to check the foundation, we're going to test the load-bearing walls, and we're going to see if this bank is actually built to withstand pressure or if it's going to crumble when things get tough.
Okay, so let's start right there with that big flashy headline. The very first pillar of our analysis has to be scrutinizing the quality of these so-called record earnings. We need to know, is this incredible performance coming from their core engine, the day-in, day-out grind of making loans and taking deposits, or is it being propped up by some kind of temporary one-time gimmick? I'm telling you, the quality of the earnings, where the money actually comes from, that tells you everything you need to know about the company's future.
So here it is. This is the number that got all the algorithms and all the headlines buzzing. A record earnings per share, or EPS, of $2.89. On the surface, that's a blowout quarter. It's a massive beat. Looks fantastic. But hold on a second. Because when we do our job and we strip out all the one-time, non-repeatable stuff, the adjusted number tells a completely different story. It's $2.48. That is a 41-cent gap between the big, flashy headline and the actual reality of their core business. The real question is, where in the world did that extra 41 cents materialize from? Because I can promise you, it wasn't from making more loans.
And this table right here, well, it lays it all out in black and white. This tells the whole story. You see that headline net income? A really strong $177.3 million. But look at what we have to subtract to get to the real core number. First, boom, an almost $18 million gain because they sold off a merchant banking investment. That one-off event accounted for a full 29 cents of their EPS. That's not a real operation. You can only sell an asset one time. It's not repeatable. Then, you see they got a $7.2 million benefit related to an FDIC special assessment. Well, that's another 12 cents per share that has absolutely nothing to do with their core banking business. So you pull those two temporary, non-recurring items out, and where do you land? You land at the real number, an adjusted net income of about $152 million or $2.48 a share. The record quarter was, let's be blunt, manufactured. The core engine did not have a record quarter, not even close. Okay, so the headline was definitely inflated. But, and this is a big but, that does not mean the entire story here is bad. Far from it, actually. To really understand a bank's structural health, you have to look past the accounting tricks and analyze the core engine itself. And for a bank, that means the loan book. Are they actually growing their main business? Are they lending more money out to good, creditworthy customers? Because that is where real, long-term, durable value is created. So let's dig into that.
Now, this is where the bull case really starts to build a serious foundation. Look at that number. Period-end loans grew by a massive $786 million in one single quarter. That's a 3.2% sequential increase. In this environment, where so many other regional banks are shrinking or struggling to find any growth at all, BOKF is expanding, and at a really healthy clip. This isn't some small, insignificant number. This shows real, powerful momentum. It shows that there's real market demand for what they're selling. This is what a healthy, growing bank's engine is supposed to look like.
Whoa, hold on a minute. A big, shiny top-line number's great, but we got to pop the hood. Where specifically is that $786 million of new debt coming from? This chart shows their loan book is 59% commercial loans and another 22% in commercial real estate. Now, given all the panic and the headlines about the CRE market, we have to ask the tough question. Are they just piling into risky, empty office building loans to hit a growth number? Or is this actual, high-quality, durable growth in things like manufacturing and industry? We need to see the breakdown. I'm not taking that headline number at face value. And that's a fair challenge. But this chart gives us the answer we're looking for. The growth is coming from the right places. It's coming from what I'd call the load-bearing part of the portfolio. General business loans, that's your bread and butter, commercial and industrial stuff, they were up $236 million. The services sector, which includes really stable clients like governments and nonprofits, that grew by another $201 million. Even their specialized energy business, which is all about low-risk, reserve-based lending, it saw a huge rebound of $201 million. And then you tack on another $130 million from healthcare. This isn't risky speculation. This is diversified, high-quality C&I loan growth. This is the core engine firing on all cylinders.
Firing on all cylinders? I don't know, maybe in one part of the engine, but certainly not everywhere. Because while that commercial book was roaring ahead, their commercial real estate portfolio actually shrank by $81 million in the same quarter. And look where they're pulling back from. Multifamily apartments down almost $68 million, industrial properties down $28 million, retail space down $20 million. To me, it looks like this bank is deliberately and actively hitting the brakes and de-risking from CRE, which is the one sector that everyone is terrified is about to drop. So while one engine is accelerating, they are clearly slamming the brakes on another. The question you have to ask is this just smart risk management, or is this a blinking red light that management sees serious cracks forming in the real estate market?
And that's the central tension, isn't it? That push and pull between the C&I growth and the CRE contraction is absolutely critical to understand. But here's the thing. A powerful loan engine, no matter how good it is, needs a rock-solid foundation of stable, cheap deposits to stand on. Remember, a bank is a two-sided business. Its assets, the loans, are only as good as the liabilities that are funding them. So now let's put that foundation to the test. Let's analyze the strength of their deposit base and their overall liquidity. And that foundation, well, it looks like it's built out of granite. In fact, it's actually stronger than their loan growth. BOKF grew its deposits by an incredible $935 million in the fourth quarter. Let me put that in perspective. They brought in more cash from new deposits than they lent out in new loans. Any year where you read headlines every single day about depositors fleeing smaller banks for the so-called safety of the giants, BOKF is a magnet for capital. This is the ultimate sign of a healthy, trusted brand. It gives them all the stable funding they need, plus a powerful cushion of liquidity.
Okay, all right. You can't argue with this metric. I'll give you this one. A 65% loan-to-deposit ratio is, well, it's fortress-like. It's what you want to see. It means for every single dollar the bank is holding for a customer, it's only loaned out 65 cents. The other 35 cents, that's just sitting there in cash or other super liquid assets. That gives them a massive amount of dry powder on the balance sheet. They can handle a wave of withdrawals, they can fund new loans, all without having to go beg for expensive funding. In this market, that is one of the clearest signs of a conservative, really well-run balance sheet. That's a major pillar of strength, no doubt about it.
So, we have a core loan engine that's growing, and it's being funded by a rock-solid deposit base. That's great. But here's the thing about banking. Growth without discipline is a one-way ticket to disaster. The real true test of a bank's long-term durability is its underwriting culture. It's their risk management. See, anybody can grow loans by just giving money away. But if you're lending to the wrong people, it will eventually come back to haunt you. So it's time to check for cracks in the armor. Let's take a hard look at their credit quality. Okay, this number is, well, it's frankly staggering. Look at this. Net charge-offs, these are the actual loans they had to completely write off as a loss during the quarter, were just $1.4 million. That annualizes out to a measly 0.02% of their loan book. I mean, that's practically zero. It's a rounding error. This isn't just good credit quality. This is elite. This speaks to an underwriting process that is just reinforced with steel. They are absolutely not chasing risky loans just to hit a growth target. And this just confirms the story. This isn't a fluke. Look at their non-performing assets. These are loans that are getting into trouble, the ones that are close to or already in default. That number held stable at just 0.29% of their assets. Now, for context, anything under 1% is generally considered pretty healthy. Under 0.5% is considered excellent. At 0.29%, BOKF is operating at a truly best-in-class level. There is simply no signs of stress here, no deterioration. The armor is holding up incredibly well. Their credit discipline is, right now, beyond question. So let's recap where we are. We've established they have strong core growth, we've seen a solid funding base, and we've just confirmed pristine, almost unbelievable credit quality. The final pillar of strength for any bank, the ultimate buffer against any unforeseen economic storm, is its capital position. This is the loss-absorbing cushion.
This is the final firewall that protects the bank and its depositors from big, unexpected losses. So let's examine just how well fortified BOK's fortress really is.
At first glance, the fortress looks impregnable. I mean, just look at these numbers. Their Common Equity Tier 1 ratio, that's the highest quality capital, the purest form of loss-absorbing cushion a bank has, it's sitting at 12.89%. The regulators only require them to have 7%. That means they have a cushion that is nearly double the minimum requirement. That's a massive buffer of almost 600 basis points. And it's the same story for their Tier 1 and total capital ratios. They are way overcapitalized. This is a sign of immense financial strength and resilience.
But being well capitalized is one thing. How you manage that capital is a whole different story. It's great to have a thick fortress wall, but what were they doing with it this quarter? They spent a fortune actively knocking it down. They repurchased over 2.6 million of their own shares, spending a staggering $282 million in cash to do it. And what was the result? Their tangible common equity ratio, another critical measure of their safety buffer, dropped by 60 basis points in a single quarter. It went from 10.06% all the way down to 9.46%. Yeah, sure, they're still well above the minimums, but they are actively and aggressively thinning out their own fortress wall just to buy back stock. In an economy this uncertain, does spending that much cash to shrink your safety buffer seem like a prudent move? To me, it feels like they're choosing to juice the stock price today at the potential expense of maximum durability for tomorrow.
And you just hit the nail on the head. That is the central debate with this company right now. It's a battle between undeniable operational strength on one side and a really aggressive, maybe even questionable capital strategy on the other. We've examined the quality of their earnings, we've inspected the loan engine, we've tested the deposit foundation, checked the credit discipline, and measured the fortress walls. So now it's time to weigh all the evidence. It's time to balance the steel beams against the stress fractures and deliver the final iron financial verdict.
All right, let's lay out the bull case first. The steel beams supporting this company are absolutely undeniable. First, that core loan growth in the C&I sectors is genuinely impressive, and importantly, it's diversified. Second, the credit quality is fortress-like. I mean, near zero losses. That points to an elite risk management culture. Third, the deposit base is a rock. It's showing incredible stability and liquidity at a time when that is absolutely paramount. And finally, let's not forget their fee-based businesses continue to grow, which adds another stable, diversified layer of revenue. From a pure operational standpoint, this is a very strong bank.
But you cannot ignore the stress fractures. First and foremost, that record earnings headline was manufactured. It was an accounting illusion, plain and simple. Second, they are actively and quickly shrinking their commercial real estate book. That could be a major red flag about a huge part of the U.S. economy. Third, that massive aggressive share buyback is thinning their capital cushion at what seems like exactly the wrong time. And here's one last point we saw in the data. Their core loan yield, the interest rate they're earning, actually decreased by 22 basis points this quarter. That signals some real pressure on their future profitability. The foundation is solid, but there are clear and visible cracks forming.
So here it is, the final verdict from Iron Financial. BOK Financial is a disciplined, high-quality bank with a strong operational foundation. The credit quality and the liquidity are undeniably top tier. There's no debate there. However, that Q4 headline was absolutely manufactured, and their capital return strategy is very aggressive for this point in the economic cycle. So this is not a trap. The underlying business is simply too strong for us to call it that, but it is also not the clear-cut, unblemished signal of strength that they presented it as. The flashy exterior that you saw in the headline has some very real cracks when you get up close and inspect it. This is a high-quality company that is making some aggressive choices, and that means it requires very careful monitoring going forward.
And that leaves you, the investor, with the final question you have to answer for your own portfolio. It really comes down to the ultimate trade-off, doesn't it? On one hand, you have a company with a powerful, high-quality core engine. On the other hand, you have a management team that is actively choosing to take a sledgehammer to the fortress walls that are designed to protect that engine during a storm. Is that the right balance of risk and reward for you, right now? In this economy, is that the kind of structure you want to build your financial future on? That's the question you have to answer. Thanks for joining us on Iron Financial.
I am not a financial advisor. This is for educational and entertainment purposes. Do your own research.